his wife and daughter have the over there our church club. Thank you for coming. Have Michael, son of Roland Daize, of course his wife. And thank you, wonderful people, for coming out here to listen to the presentation. Thank you, Lisa. She's there on in the information room. And at this time, Mr. Daize, I present Pastor Williams first, and then he will present you. Thank you.
Okay, good night, everybody. Be seated, please. We live in a world where it's important that we have it right when it comes to our tax, when it comes to our finance. I've known a lot of people who in the religious circles who have gone to prison because they did not get their books in order. And I'm one person who do not intend to go to prison for that. So I would encourage these kinds of activities. And thank God we have people in the church who can educate us about all matters, including fiscal matters, things regarding our taxes. And there's a lot of trends now and new development. We need to know what is happening. We need to know what's going on in the country. And the Brother Daize is here to make us wise. So I want to just pray a quick blessing on what he's going to do. And then we're going to be enriched by his knowledge. Let's bow our heads. Dear God, I thank you for this session. Lord, you said, given it shall be given unto us, good measure, pressed and shaken together. Lord, when we receive that overflow, we need somebody to help us manage. Thank you for people like Brother Daize, who will educate us on these matters. And I thank you because he has made himself instrumental in being here tonight and teaching us about the tax, because these are serious matters. You said, Jesus, that we must render to Caesar the things that belong to Caesar. And our Caesar is the United States government, right? And the tax department, federal tax department. And we are going to make sure to put our house in order when it comes to that. Thank you again. Bless his presentation in Jesus' name. Amen. At this time, receive Brother Daize as it comes to enrich our lives.
Thank you. Thank you, Bishop. And I just want to say thank you for those of you who are able to make it here tonight. We hope that this is going to be an enriching moment, because this information is so pertinent to our natural active lives, not only federal government, but also state government and state, because we do taxes for all over the United States, all the states and so forth. So I've already been introduced, so we can proceed. Is that okay with everybody? Are we live? Great. So I just want to say thank you, Bishop, for having us tonight. My son and I, Michael, is in my footstep, hoping that he would be able to fill it someday when God spare life. I hope to retire, and that would be certainly my dream. So I want to focus mainly tonight on federal tax returns. There would be some elements of the state, but really it would be mainly the federal changes, some aspects of retirement plans that are really important to us. So I hope you enjoy, sit back, and hope we can obtain as much information as possible. All right, so the main topics we're going to have for the discussion, and I did have a leaflet I would have circulated to quite a few persons. A briefing of the law, the new tax as it affects new tax changes, as it affects us 2024 and beyond, starting document, mileage, the third-party networking, new key vehicles, CVC, electric vehicle, the energy efficiency, which is something we need to look at critically, residential energy, clean energy, property credit, homeowners benefits, pensions, effects of the of course, our work and taxes as it relates to Social Security and Medicare. Itemization in brief, Schedule C, of course, itemization Schedule A, business Schedule C in brief, the ITIN and ITIN renewal, which is, of course, ITIN, those persons who are not eligible for Social Security number, they can apply as long as they are working and do have income that is taxable, need to apply for a tax ITIN. And I'm going to go into the detail, various refundable, non-refundable credits, and briefing on, the business, non-profits, and so forth. And please note that what we will do after the presentation, we will have questions, so it would be nice. And what I'm going to do is, ask my dear wife, there are some gifts.
It's on Facebook Live also.
Have brought.
Rima CG.
I'm going to make sure everybody get a gift tonight. We're going to give you some gifts so that you can get a pen in which to make notes if you need to. Some aspects of the presentation, I didn't want to print too much paperwork, but I can send aspects of it for you if you do need. So we're happy to have you and welcome again. Is everybody okay tonight? Thank God the weather held really good so we can have a wonderful time. I know we are streaming. There are a number of persons we know should be or would like to be online also. So in our next slide, I just want to mention the important tax laws and the relevant issues and why it is important for us to look at it. We as tax professionals are well trained on tax issues. That's why I'm here. That's why I'm standing before you tonight. There are issues with ghost preparers that you have to look out for. These are people who do not sign a tax return and do charge a fee. So I'm warning you, be very careful for tax ghost preparers. They do not sign your return, they charge you a fee, and sometimes you don't know. Most of the times, it's not until a client comes to me and I show them the bottom of the 1040, it's not signed, it says self-prepared. So be cognizant of that. I also want to mention that for the first time in the history of taxation, which is over 200 years, the IRS is offering also a free tax portal where you can do your taxes online. So rather than using TurboTax, Tax Act, you can use it direct. So I just want to also mention to you that aspect of it. And I'm mentioning it because I have no fear that my clients are always going to be with me. Why? Because I know they are 100% satisfied. And not only that, they can look to me for any type of information that is relevant. So we want to look at also tax professionals like us who can represent you before the IRS and the state. Once we do your tax return, we can represent you accordingly. We are open all year, so you can get access to us. And that's the beauty. We have our phones, contacts, so you always access to us. Moreover, we can discuss issues with the tax department, whether it's the federal or the state, once we do a POA, which is power of attorney. Once we do that electronically for you, then we can proceed to get access to your tax information, represent you, deal with tax issues, and so forth. So we're able to do all of that. Look for tax scams. This is one of the biggest issues, I think, today, especially for the elderly. There are scams, there are phishings, which are dealing with emails, and phishing spell, of course, phishing. There is also smishing, which is unsolicited text. So see, there are terms that you have never heard of that are existing today. So please look out. The IRS and state are never going to call you. They call you about that situation. They will never threaten you. So be aware of that also. There is also spear phishing, which are tailored attempts to specific business and business entities, non-profit organizations, where they're trying to scam. So be look out and be on the alert. There is bogus calls. Someone calls you and they will tell you, they're calling from IRS. I need to know what's your social security number, your name, your date of birth. Please, they will never call you. They will, most of the times, 99.99%, they will write to you. So please be aware. This is a very important aspect, and I just want to spend a minute or two discussing it with you. So please be aware they will never call you for scamming. Anytime you hear someone calls you and asks for your social security, just let them know. I would suggest hang up, and you're going to report the matter to the police or to FBI, which is what I often do. And once you are satisfied you have that information, you can also report it. You can call me if you need help in dealing with this. We would give you some information also. So there are bogus calls, fake charities. There are fake charities out there, you would be amazed, that are telling you you can donate and you can send money to them and you can use it on tax return. Be very careful, they are fake. Unless it's a, for example, 501c3, which is through the church. That's the ambit of the category of the tax law that the church falls under. Or, but it's a synagogue, or once it's a religious organization. Okay, so be aware of that these are some problematic areas that many people are scammed into. If you have any issues, please give me a call, reach out to me, and let us know, of course, Michael. Okay, our next slide shows the new standard deduction, which I'm not going to go into detail. For example, what this shows you is for a single taxpayer, the amount that you can deduct for yourself before any taxes. In other words, the tax-free amount is $13,250. So for example, if someone worked with a W-2 and have, let's say they work $12,000, they may not need to do their tax return except if they have, for example, withheld taxes so that they can get it back. So the same with, for example, married. As it relates to this aspect of it for gas, the higher the gas price is, the higher the rate they would allow. Okay, next slide. Let's look at the third party network transactions. Now, there are again some slight changes here. And it continues to change. They were hoping that if in the case of, let's say, you Uber or one of those third party, or you do some business with someone, and let's say they pay you by Zelle or by one of the other stuff that are out there, Cash App and all of those stuff. So they're still wriggling and working, bringing the changes where as it relates to this third-party transaction network. So that at the end of the year, Cash App, for example, would give you a 1099K. If, let's say, you work for, in this case, the change that modified it recently to $600, okay? So if, let's say, you work for $600 with someone and they pay you through Cash App, then you'll see that register as business and Cash App would then send you 1099K. Okay, so these are changes and it's going to continue for the next year to change. The same with Zelle, and it's going to happen because they're going to force you to and ask you, is it business or is it personal? So if you indicate business and it exceeds the 600 threshold, you will get a 1099. So be aware of that. All right, let's go to the next slide. The clean vehicle credit. And there is a $7,500 credit for clean vehicles. That is for CV or electrical, 100% electrical vehicles. Okay, and that credit is going to be applicable up to 2032. So for example, if you buy a vehicle that is, let's say, $55,000 and it's 100% electrical, you will be able to claim that $7,500 on your tax credit. Now it's and let me also mention, it's a non-refundable credit, which means that it goes to erase your taxes up to zero. So for example, if you do your taxes and let's say your income was $100,000, and let's say you bought one of these vehicles, you paid let's say $50,000 for it, you apply for the credit, but let's assume your taxes is only $5,000. You will be able to write off just the $5,000 for that year. Okay, and that's the way it works. The rest of it, of course, depending on different situations, can be carried forward to the next year. So this is one of the very important aspects of the CV vehicle. I also want to mention that these come with certain limits. For example, if you're doing married filing joint and you make more than $300,000, you would not get the credit for this deduction. If, for example, if you are head of household, that is someone who has a qualified dependent, then you are only, if you make more than $225,000, you would not get the credit. So there are limits. In other words, what the government is saying here, listen, we're offering these credits to help you, the middle income earners. But if you are making some big money, you're going to have to pay, or you would not get that credit, this particular credit. 150,000 for other files, like you file in single. So if you file in single and you make 150,000, that's the limit. Beyond that, if you make 160,000 and buy one of these vehicles, you wouldn't get the credit. Okay, so there are cutoff points. I just want to make sure that we understand it as it goes. And the way in which the complicated tax system is, you know, we're dealing with a tax system that is the most complicated system in the world. Okay, now let's go to the next slide. Let's look at the vehicle credit continued. And just to mention that it has to be a brand new vehicle. So you can't buy you can't buy a used vehicle and expect to get the credit. It has to be brand new. All right. And there is a procedure code of 2022-42, which specifically lays out the guidelines. Another aspect of it it must be a manufacturer suggested retail price. So there can't be anything bogus where you spend $70,000 for the vehicle and you try to make it look like you only spend $60,000 to get the credit. No, it has to be from the manufacturer must be an accredited institution, meaning they must register with the IRS, and two, you must be able to get this information directly from the buying institution or business where you bought that vehicle from. So for example, you cannot exceed 80,000 for vans, SUVs, and pickup trucks. Okay, so just be aware of that also. So there are also some limits. Let's look at the other slide. Energy efficient home improvement. Now, over the years, I believe in and continue to encourage taxpayers to buy their own homes. Why? Because this is where you can end up with these tax credits. So for example, if you have a house, and let's say you buy some new doors that are energy efficient, and you would see the energy efficiency information on the doors, on the windows, then you can get credits for them also. So be aware of that. So if you have a house presently, and quite a lot of clients I have who have houses and who depend on this also for changes. May I also add that I'm not really going to go into any Schedule E information, which is persons who are renting, because that's another whole, I can take another 2 or 3 hours discussing rental of property. But I'll just mention it here that there are some changes also for rental of property. For example, you can buy, if you have a house that's 2 family, and you're living in half, you're renting the other half. There are certain deductions that you can take. For example, before 2018, if you buy a used piece of equipment, you may not be able to depreciate it. Now, they allow you to depreciate that piece. Let's say it's a fridge. You would be able to depreciate it. And this is dealing with some accounting aspect, which again, I don't want to get into too much details. I just want to try to maintain simplicity. So bear in mind, once you have a rental property, I would ask that you discuss with me so we can delve into it and point out quite a number of issues. There are some changes. So as it relates, for example, to an exterior door, you can get 30% of the cost, up to $250 for the door. Okay, or up to $500 maximum. Exterior window and skylights, 30%. Insulation materials and the system, air sealing materials, etc., up to 30%. So see, they're all incentives. But
we got a question over here for anybody. We have a question.
Someone has a question? Okay.
Yes, hi. I heard before, first of all, let me say thank you so much for all the information that you're already giving. It's very, very informative. The question that I have for you is, I heard that you talked about electric vehicles. Now, what about hybrid, half electric, half gasoline? Does that go into the tax rebate as well?
Excellent question. So no, it doesn't. So hybrids, unfortunately, are not considered at this time. They are really encouraging everyone to go fully 100% electric.
Electric. Okay.
Okay.
Thank you very much. Thank you.
You're most welcome. And thanks for that question. Quite relevant. Okay. So again, it's only 100% electrical vehicles. And may I add, those vehicles must be produced in the United States. Of course, I totally agree with that, because we have this is about productivity in the United States. We love our country, and we have to. Those of us who are, of course, many of us, most of us, are immigrants there, but we have to be thankful nonetheless. All right. Next slide. Home improvement credit, right? And again, this relates to residential energy property up to 30% cost of, including labor, of course. Excuse. If we have central air conditioning, central heating, propane gas, and all of that stuff, you can and will be you will be enabled tax credit once you are eligible. Okay, I just want to make sure because there are also some cutoff points where your AGI is concerned. Okay, which is your annual gross income. Okay, are we okay so far? Good, good, good. I don't want to. I hope this information is not going to be an overfed, but I try to condense it as much as we could so that we can disseminate this information effectively. All right. Home improvement credit continue. We mentioned the heat pumps, the biogas, and so forth. Again, it's a 30% of the cost, including the labor. Obviously, you have to install it. Okay. Let's go to the next slide. Residential clean energy property credit. To the next slide. Okay, great. So we have, again, the clean energy property credit is 30% on cost. So in other words, let's be practical. You spend $1,000 putting in, let's say, fuel cell property expenditure, for arguments. Or let's go to, and I'm going to give you examples. Solar electric property expenditure. We put in, you have a house and you put in a solar system. And let's say it costs $30,000. Then you will see right there, once you make the payment for that particular item, the installation included and so forth, you can claim 30% of the $30,000. That's $9,000, right? Okay, so that's the amount that you can claim on. Again, this is a very, very important aspect of owning your property. That's why I encourage people to own your property. Let's move on to an example. So I showed you an example where you invest, let's say, $30,000. And let's say you pay $200 per month. And so this $30,000 you invest with the solar system. So you're paying them back. You didn't take a loan. You didn't pay cash for it, but you took it from the solar company. $30,000 is the total cost. And you're paying $200 per month. 12 months, that's going to be $2,400. So the amount you are eligible for as a deduction for the year would be 30% of the $2,400. In this case, would be $720. So that's going to be the credit that you will obtain for that particular year. And the credit goes on for quite a few years. All right. Note, may I add that the credit is non-refundable. For example, they know very well that someone who's earning $20,000 may not be able to afford a property. Okay, so they know very well that that person would not have non-refundable credits. Usually, in this context, it would be someone who maybe have 80, 100,000. Higher income bracket to afford to maintain a house. So what they would do is they know that in this case, that person probably would have maybe tax liability, let's say 100,000. You're single, 100,000 is your income per year. Unless the taxable income is about, argument's sake, let's say 85,000. It's there, and let's say your taxes, let's say is 10,000. There you would be able to deduct that total amount from your tax liability. So it's going to lower your tax liability, which means it can increase your refund or it will decrease the amount that you're owing Uncle Sam. I guess everybody knows Uncle Sam, right? I was tempted to change the name, but nonetheless, so that's how it works. Is everybody okay on that? So this is a very important aspect of owning your own house. And not only owning the house, Brother Cardinal, but also investing in a solar system. This is really important. This is why I would encourage us to do that. All right? Okay, let's move on to a second simple example. So let's assume you invested 30,000 1 year. You took cash or you borrowed a loan because you're not responsible for that loan personally. You or your wife or whoever else. Now, so you have 30,000. That's a loan that you're responsible for. You would end up getting the 30% deduction for the year. So of course that's $9,000 that you can, for example, I have clients who would have gotten back $25,000, $24,000 refund because of these type of deductions. So that's the good thing. So look at it. I want to also look at the same token as an investment. One, putting in a solar system in your house, on the house, whether it's on the roof, wherever, of course, where sunlight is accessible, 80%, you are adding to the value of the property. So the property automatically appreciates. So if you put in a solar system that is, let's say, 30,000, and your house, let's say the house is valued at 300,000. There and then, it's not just going to be 330,000, but it's an inflated appreciation that's going to take the house way up from 330,000 to maybe 360,000. So that's the investment, which is really important. And not only that, it also drops your electrical bill. I've seen electrical bill from clients who have dealt with where they're paying just $5.50, $9.80 per month. And I'm telling you because I've seen it. So it's good to go green. Let us all think we're saving the environment. And if each one does it, each one is going to benefit from the environment. Isn't that true? So let us look at it in that light. Not only that, let's look at the second aspect, that if we invest in, let's say, 30,000, that's where on earth, now, today, could you invest 30,000 and get back an investment of 9,000? So that's, again, something that we need to look at. Let's look at ways we can invest our money. If you put 60,000 in the bank and you have a house and don't have solar, you only get in what? Maybe what? $200 maybe? Well, if so much at all, right? So let's assume it's in a savings account. You have it in a savings account, you make $100 maybe interest. Look at the difference in investment. So not only am I showing you the tax relevance, but also the economic benefits that will empower you, that would strengthen you, and would make you a better person economically. And this is where, when God blesses you, you have to take advantage of that blessing and go right out to take the benefits and to utilize those benefits. So everybody's okay so far? Let's look at individual retirement account, IRA. Now, of course, IRA mainly fall into two categories. Mainly, it's either traditional IRA or Roth IRA. Traditional IRA, if I may explain, is really one where you're actually postponing paying the taxes on it. No. And when you retire later is when you pay the tax on it, which I think is a very good idea. Because to be honest with you, let's say you are 60 now, right? And you're still paying into your IRA. You have, let's say, a traditional IRA. So with a traditional IRA is what we call a tax deferment. Tax avoidance is the term that is used, which is 100% legal. Compared to tax evasion. Evasion is where you are doing things to avoid paying taxes legally. But with avoidance, you are doing it illegally. There are these mechanisms that the government put in to help you. So if they're there, why not use them? And that's why I'm here to tell you about it tonight, to encourage you to invest in a pension plan. Invest in a pension. If you are a low income bracket, you can get what is called a savers credit. You make, let's say, married filing joint, 30,000 per year, and you have, if you save $3,000 between you and your wife, you can get a credit on the savers plan. Moreover, whatever you put into it, if, for example, you're 50 years, if you're 50 years or younger, you can put in 6,000 tax free. In other words, it's 6,000. The way it is calculated, it's $6,000 less your taxable income. So if your taxable income is 30,000, and let's for argument's sake say that it's 10%, that's basically 30,000. You're paying 3,000 in taxes, correct? But let's assume now you invest in a pension plan, $5,000. You are lowering it by down to 25,000, 10% of that. So right there, you know, from the federal level, you are saving $500. Isn't that a good saving? That doesn't include the state. That's another approximately almost 9% from the state level. So everywhere you look, there are avenues in which you can benefit from pension plans. And this in particular, I like to encourage my clients to look at traditional pension plans. The Roth, on the other hand, you have to pay the taxes now. So with a Roth plan, you pay the taxes as you work, as you go. But what happens if you're 50 years now? We don't know if we're going to reach 60. We don't know if we're going to reach 70. Let's wait until the government allows us to wait until we get to that age in which to make the payment. Whenever we take out the money from the pension plan, which is of course, when we put in, we make contribution, and when we take out from the pension plan, we are actually taking money that we would have invested over the years. Just one. Let me.
Yeah, there's some insurances that you put in like investment. Would that have anything to do with that? Very good.
Very good question. No. For life insurance, no. Okay. And death insurance, life insurance, no. So there are certain annuities that you can invest in that will allow you to. And that I normally network with experts in that particular field to enable you, the individual, to invest in the best plan. So usually we would look at what your financial portfolio is, and then we would invest accordingly. We let you speak to that professional, and then you can invest accordingly. And I would guide you in showing you and ensuring that, for example, you want to postpone your taxes until you're retired. I want to make sure that you're using a traditional plan rather than a Roth. Is this making sense to you? Are you guys in the back hearing clearly? Good. So these are the benefits that we have with question.
Okay, question. The traditional IRA is something like a 401k where you pay the tax, and when you get the money, you pay the tax then?
Correct. So the traditional IRA, under the traditional IRA, there are 401k, there are 457, 503, 43 rather. So there are different types. There is the simple, and so forth.
Well, I look at this as, okay, when you're paying the taxes for the traditional IRA, right? If you let them take out the tax. Remember the age, we might have dependents at that time. But then when you come to the retirement age, all the children grow up already. You have nobody to pay taxes. But you don't think it will fall into a higher tax bracket.
Excellent question. Excellent question. And I have the simple answer. Usually, when you are working and you're paying, if you postpone the taxes, that's usually when your tax is higher. Because when you are retired, it's expected that your income would be far lower. Usually on a pension or pensions, for example, MTA, and those guys, teachers may have pensions, MTA guys, we have, and I say generalizing, 2 or 3 pensions. So what happens here is usually when you're working, you might be working for, let's say, 150,000. Your tax bracket might be, let's say, 22%. So if you, at that point, you're paying 22%, whereas you can avoid paying that 20. One, if you contribute, it can take you in a low tax bracket, perhaps at 20%. Okay, maybe down to from 12% to 10%, depending on the bracket. So in that context, you are actually saving because you're saving on a higher income during your time you work compared to when you are retired, when your income is much lower. So even though you may have dependents and factors, those are really not going to be adversely affecting. And if I had the time, I would crunch some figures for you and to show you the benefits, but time wouldn't permit me to go into details. But the point is, and the question is, yes, you do save more when you defer the tax, when you use, for example, a 401k plan, when you use a traditional IRA. Yes, questions?
Can I speak while I speak?
Yes, of course you can.
Referring to the question of traditional, what I understood, I'm wrong. In my company, MTA, okay, you are allowed to withdraw 401k. Young age that is below 59 and a half, you have a 10% penalty. Right? But if you retire, right? I'm not paying here for actually default, paying back, you know. But when you retire, you're still subject to the penalty, but a taxation of 20%. So as I see it, right? Irrespective of how you take, they take what you want to. They encourage you to save it. You have spirit of but you have to take. They know what they're looking for. They tell themselves it's not. There is one more thing. You might be hearing something we call abbreviation RMDI. Okay, RMDI, I think. I might be. You might be able to. Now, they're telling you that it's nice of you to say, want you to say, but they tell you at a certain age, it's time for us to have what we want. Even if it's $1 you take out, it's $1,000 monthly. Fact remains, they want you growing. They're investing on it. They're making a lot of millions, but they will touch yours.
So very good, and that's a very good point. So let's just to answer the question and to elaborate a little. There are 2 terms I want us to understand. Contribution to an IRA, that's when we put money into it. And then there is the distribution when we take money. So in the context of what you're saying, what you're doing and the RMD that you're speaking about is the minimum distribution, which I do have a slide actually speaking about that I'm going to touch on. So if you don't mind, I'll touch on that a little later. So what they're saying is, which is the minimum amount that you must take when you reach retirement age. That's what the RMD is. All right? No. In terms of the pension, so let's assume when you were working,